Welcome one, welcome all to DeFi Crypto and Airdrops. This is the DeFi Masterclass edition every Wednesday. And with us as always is Jake from Builder Wealth and David from DeFi University. How you doing, gentlemen?
Doing good today, Mike.
Awesome.
Outstanding.
Well, I'm going to go ahead and put my screen up real quick. And I want to kind of introduce your guys' products because, one, I use them. They're great products. But two, you gentlemen every week show up. This is not paid for. This is not, incentivized in any way. You just love, helping people learn DeFi, kind of kindred spirits of mine. So, I definitely like to kind of give you guys a shout out. But Metrics Finance, it is something that I've been using for quite a while now, and it's a DeFi portfolio tracker and a liquidity pool simulator. And take a second, Jake, and kind of give us an update on some of the new functionality and some of the things that you have coming up.
Yeah, 100%. It's super cool stuff that we've been working on, and the way that we kind of ran things is like Metrics started off as like just a kind of side project, I guess, and is strictly focused on liquidity pools. And for a while, we only focused on liquidity pools. And now we support lending and borrowing. And the next variation, which should be going live hopefully in like February sometime, will be basically a completely revamped, developed from scratch version. A lot of the stuff that we're working on, we just expanded our team. We doubled it. But a lot of the stuff that we're working on is data accuracy and like showing you how up to date and fresh the data is. Speed. So a lot of the stuff will just be natively saved in our database. So that way things don't have to go and pull from external sources. It's more cost effective, but it also helps you guys out when you want to load positions that maybe you've opened maybe a year ago. We don't have to reload those. We can just pull it from our database. So that way it's a lot quicker. As well as we're starting to implement like overall portfolio tracking. So you'll have like something that's kind of like the bank, but for Solana as well as EVM in the same place. And you'll be able to go right into the details of your actual like profit loss for positions and stuff like that. So, yeah.
Perfect. So let's kick it on over to David. So David is the founder of DeFi University. Those of you that watch the channel know exactly who David is. I'm always, invoking his name when, I talk about people that are insanely knowledgeable about DeFi. And I know that you made some changes recently, basically made all of DeFi University free, except for the twice daily calls, Monday through Friday, where you get one-on-one, they're an hour long each. You get, well, not one-on-one, you get the community and David live where he gives lessons and you can ask questions of him in the community. So that's the only paid part. And that's last I looked was $97 a month. And David, kind of give us a little bit of a rundown on, anything new with DeFi University.
Sure. Yeah. So, the thing with DeFi University is high quality DeFi education is really difficult to come by. And I built what I think is the best DeFi education in the English language. So I actually
turned that in the English language.
I think it is because there isn't really DeFi education in Spanish or in German or in Arabic. Or I haven't looked. I don't obviously speak Mandarin or Japanese, so I wouldn't know. But it's definitely the best in the English language. And I actually turned all of the courses that I wrote into books. So all of those books are available on Amazon. I've actually sold some of them, if you can believe it. I didn't think that they were going to sell, but they have. So that's pretty cool. So DeFi U is a series of 5 university level courses. And all of the educational content is totally free. So whether you're going through the content in the school community, or I actually think, Mike, the content on the website is better than the content in the school community because you can track your progress through all of the educational content on the website, and you actually earn points as you complete the quizzes and go through all of the interactive elements. You earn points, and I'm going to do an airdrop. So it's almost like engagement farming, because all you got to do is go through the free material. You'll earn points. And then at some point in the future, I'll enable you to like connect your wallet. You'll earn an airdrop. So yeah, man, this is DeFi U. So if you click here, Mike, you see where it says Course Hub up in the top right there? If you click on that, and then if you sign in, it's going to take you to your account hub, which is where you can track your progress through all of the courses. And as you go through the courses, you're going to accrue points, and those will be used for an airdrop. So all the educational material is free. What's paid is the 2 live calls each day. So over the course of a week, there are 10 hours of live calls. So yeah, this is the account hub. So this will allow you to track your progress through all of the courses. So if you click, Mike, on where it says continue learning, it's going to take you to the course hub itself, which is, I think this is probably the best way. Or if you just click on like a liquidity provision or one of the courses there. Oh, did Mike Jake, did Mike freeze? Or Mike, you still there? Yeah.
I'm here.
Yeah, so you see where it says that blue continue learning button? There we go. So this is the course hub. And from within the course hub, you can obviously go through all of the courses. There are 5 of them: beginner DeFi concepts, investor mindset, liquidity provision, money markets, and perpetual futures. So those are the 5 core skills that I think are really important to learn as you embark on your DeFi journey. All of this is free. So you can go through all this at your own pace.
Well, no, and it's something that I like to emphasize as well is both Metrics Finance has a free version that you can give it a test drive. There's of course the paid versions that have enhanced functionality and things like that. But DeFi University, the majority of it is free. We have a couple of videos on our channel that kind of give the basics, just the terminology, things like that, just very, very rudimentary stuff. But for the most part, with these 3 tools, our channel, DeFi University, and Metrics Finance, you don't really need to pay. I mean, because there's a lot of people out there that are charging insane amounts of money for a DeFi education. And, of course, when you start getting into advanced strategies or using large amounts of money to invest in DeFi, it's a good idea to potentially look at those things. But if you are just wanting to get a basis of knowledge about it and you're not necessarily investing yet, or you're just, kind of testing out with very small amounts of money, there's no reason why you need to break the bank. There's a lot of really good content here that, Jake has a channel, David has a channel. There's a lot of really good information out there that you can go through before you crack open the piggy bank and start paying large sums of money. So I just kind of wanted to, touch on that real quick, but thank you, gentlemen.
Yeah, 100%.
So, Jake, let's kick it over to you real quick, and let me remove this. And why don't you kind of give us a rundown on what you got going on right now as far as liquidity pools and what you're doing in DeFi with the movement of the markets lately and things like that.
Yeah, just had a call with some of our people. We have a free community. We just did a kind of all hands on deck call today, and basically like the thesis for 2026 is going to be a little bit different in these markets. I would say like at least significantly different than what we had last year, what we had the year before that. I mean, I remember the days in 2024 when everybody just invested into extra finance and aerodrome and like printed yield for like a good like 3 to 4 months. And, now it's like we're scraping by. And again, it's the market's maturing. It's a different thesis and you need different investments. You need to be able to adapt. So what I'm personally doing is I'm targeting lower yields. I'm trying to do about 30% per year on my portfolio. Targeting Bitcoin and Ethereum among some high quality alts. That's my accumulation portfolio. Now, one of the things I will say is like, while we're in this period where the market's starting to go back up, I want to start to take profits towards like 100, 110 per Bitcoin. Those profits, I don't want to completely funnel out of the ecosystem, but rather I want to just make a shift of money from my accumulation side of my portfolio to my income side of my portfolio, where I can generate consistent income, whether that's through directional LPs where I hedge out the majority of the exposure, whether that's through stable coins that are higher risk where I get 15 to 20%, or maybe that's stable coins where I get 5 to 8% or something through lower risk opportunities. But point is, right now I'm about 70% accumulation, 30% what do you call it, stability, which I would consider anything like semi-market neutral. I want to start to filter it towards 50-50 basically, at least leading into Q1, Q2 of this year. Q3, Q4, I feel like I'm going to be a little bit bullish as the economy hopefully shapes up. And yeah, I mean, I think it's important to realize like why we're going up. The only reason why we're going up in, past 24 hours, we're now going down. But the reason why we were going up is because the price of oil was going down basically. And because of the capture of the Venezuelan president, obviously shot the crypto market up in the short term. So again, that's just kind of like what my portfolio is doing. Accumulation, low yield, 30% is my goal for the overall portfolio. Can be accomplished through liquidity pools, lending and borrowing, and staking, like a mixture of them. And then on the stability side of my portfolio, I'm looking over at 20% per year return on my overall portfolio. Because my goal is if I can get like $500,000 scaled up 20% per year, I'll have a nice little paycheck coming in every single month. So.
Hell yeah.
Well, Dave,
man.
let's kick it over to you because I know that you're more geared towards income. Just because that's pretty much how you make your living is in DeFi. So if you could take us through kind of what you're doing right now.
Man, it's been tough, Mike. So what I've been doing is spending almost all of my time building research on Uniswap v3 and v4 liquidity provision. So I got started in finance in 2010. I don't necessarily want to say I got started in finance, but that was when I first started trading. And I first started trading in 2010, 2011, gold and silver during their first move higher. And then in 2012, I was introduced by a friend of mine to Tasty Trade. And I learned from Tom Sosnoff and Tony Batista how to trade options. And so over the course of the next decade, I became an options trader. And that translated really, really well into the world of DeFi. Now, liquidity provision is a derivatives contract. It is a complex derivatives contract. It's very, very similar to trading options. And I've noticed, I basically went full-time in crypto in 2023, and then I went full-time as a liquidity provider at some point in 2024. And now, over the last 9 months or so, I've been living off of that income. And what I've found is that there are hidden costs to providing liquidity that most beginners and many people who claim to be advanced have no idea about. And I don't know, Jake, have you ever noticed this where, let's say you provide liquidity, let's use an ETH USDC pool as an example. You provide liquidity, let's say ETH is sitting at like $3,000. You got an equidistant range. And you provide liquidity and ETH goes up and down, and then you withdraw your fees. Let's say ETH is right where you provided that liquidity in the first place. You withdraw your fees, but your pool, the assets in your pool are worth less. So did you actually make any money in the pool? And what's the source of that hidden cost? So what I've discovered really since Gemini 3, that deep research mode in Gemini 3 launched at the end of November, I've been able to create all of this amazing research. And what I found is that loss versus rebalancing is a hidden pernicious tax on LPs. And it's very difficult to measure. So for me, as a liquidity provider, I don't think that most pools are structurally profitable to provide liquidity in the first place. And so over the last 6 weeks or so, I've been producing a ton of research in DeFi about which metrics are most important for us to track when we provide concentrated liquidity. Because I believe, having done this full time, I believe that the fee APR number, when you look at your fee APR, I think that's a vanity metric. I don't think that actually tells you anything about whether you are structurally profitable in the pool. So Yeah. How have I been doing in DeFi? Well, I'm hedged, so I've just basically been going sideways for the last several weeks, which really sucks. Um, and when I look around at the opportunities out there, I think some of the best opportunities are probably like levered stablecoin positions. Or if you're not happy using leverage, then you could just take a look at something that's paying like 12%, something like that.
So,
But
so do you mean by leveraged, stablecoin positions? Are you talking, like looping and something like that, or?
yeah, so something like going to Contango and looping a PT, or maybe just holding stables, borrowing against them, looping into those yield-bearing stables again, leverage like that. I think that makes sense because you can quite easily get up to around 20% APY by
Hmm.
levering up some yield-bearing stables. So that makes a lot of sense to me. But for liquidity provision, um, I'm not convinced that V3 liquidity provision on Uniswap
Mhm.
is, for the vast majority of pools, I don't think it's structurally profitable at all. I think that you really need some of the features of V4 hooks to actually get to structural profitability.
Can you
That's what.
get into those hooks a little bit? Because that's one thing that I have neglected to really dive into. And I know that there's risks involved because a lot of them are third party. And so, basically they can build in, potentially malicious, smart contracts, things like that. I mean, are you able to kind of dive into that a little bit?
Oh, 100%.
Can I dive into kind of what you're saying, David, regarding that APR real quick?
Mhm.
Yeah,
I
absolutely.
completely agree with you. Like you when you provide liquidity, you have something called your fee APR, which is like, okay, I parked say a grand in here and I generated $200 over the course of a year. Assuming nothing changed with your $1,000, it's 20% fee APR, right? Then you have your actual APR, which is after your opportunity cost. Now, as you're kind of mentioning, and as we've kind of discussed in the chat, like there's R bots, MEV bots. So like as you mentioned, like you might start with one ETH and 500, or one ETH and say 2,500 USDC, and then ETH goes down, ETH goes up, ETH goes down, ETH goes up. You're back where you started, but now you have 0.98 ETH and 2,400 USDC, right? Something like that, basically. Well, that should be factored into your opportunity cost, right? So one of the things that we're paying attention to in metrics is like, going forward, when we make these adjustments, we want to make sure that we're breaking down all these different metrics, because to me, fee APR does matter, but it's not the most important metric. Fee APR matters because the higher I can get my fee APR, the higher I can get my actual APR. But at the same time, I want to be able to see both. So that's part of like what we're building out. But you just have to keep that in mind. There's a lot of opportunity cost. And it's not just like against, holding the market. There's these things like MEV that you have to pay attention to and be careful of when providing liquidity.
Yes, you're exactly right, Jake. And so, what you were alluding to there, the opportunity cost, there are two different types of opportunity cost. The first one is your divergence or
Yeah.
your impermanent loss. And that's just structural to providing liquidity. You are short gamma. That's your divergence. And that is reversible. However, the other opportunity cost, which is not reversible, is called loss versus rebalancing. And the reason for that is arbitrage. So when you provide liquidity in a pool, you've got two tokens. You provide those two tokens to the pool as liquidity, but the pool is quote unquote dumb. It doesn't know what the external price is for those underlying assets. The only way it can know is if the only way it can know is if there's an oracle attached to it using a V4 hook. But
Which there used to be. There used to be. But the reason why they took that out is because ultimately the concept was proven. So now when we have no Oracle attached to it, it becomes truly decentralized, right? You can create a pool with any two assets. You set the price at the start, and now that price is determined based on trading activity in the pool. But what you have to factor in about that is you have arbitrage, right? What if Ethereum's trading at 34.9?
We lost Jake.
yeah, I think
What if it's
Jake, you back?
34.90
There we go.
on a DEX, right? And then it's trading at 3,500 on Binance. Well, then creates an arbitrage opportunity where you buy it on the DEX for 34.90, send it to Binance, sell it for 3,500. You do that at scale, you make a lot of money. And by you doing that, guess what you're doing? You're pushing 34.90 to 3,500 basically. So again, it's a blessing and a curse. For illiquid pairs, hurts really bad, or it can at least. But for very liquid pairs like ETH to USDC, it's not as much of a concern. But also at the same time, that's where some of the money can be extracted through MEV that we have to pay attention to.
Yeah, you know, it also depends on the chain on which you provide liquidity. Faster block times means lower lever. So the cost that Jake just described is called loss versus rebalancing. And, you know, I'm not convinced that it's all that small. I think that LVR plus MEV can actually add up to quite a bit over time.
I'm glad. Well, really quick, I'm glad you guys brought up that MEV. Have either of you had a chance to look at the new? I know I'm always talking about Aerodrome, but the new Aerodrome protocol that's coming out in Q2, where they're addressing the MEV issue.
I have not. No.
Mm-mm.
Okay, go ahead. Keep going then.
Great. Yeah. So I mean, no, I haven't seen that yet. But so here's something to think about. What is it that you need to look at to find what metrics do you need to look at to find out if the pool that you're providing liquidity in is giving you some type of an edge or not? Well, it's called variance. What you need is you need to be able to calculate your variance risk premium. Remember, when we provide liquidity, we are short volatility. So what that means is we need to find pools where the implied volatility of the assets in the pool is greater than the realized volatility of those same assets external to the pool. The difference between the higher implied vol and the lower realized vol, that's called variance. We need variance risk premium. So that we need a positive variance risk premium so that we can structurally have an edge as liquidity providers. Without positive variance risk premium, we really don't have an edge at all. And providing liquidity in a pool without positive VRP means that you're structurally unprofitable in the pool. So
it's interesting, David. Yeah, it's stuff that we haven't really got the chance to dive into a crazy amount because, again, as you said, a lot of these pools aren't profitable. And that's the first step in liquidity provision. Understand that not everything makes sense, right? I oftentimes see a lot of people trying to make things make sense. It's they try to make a specific pool work out. And at the end of the day, sometimes that pool just isn't meant to work out because, it doesn't generate enough fees compared to the impermanent loss that you might occur. But then the other thing to argue, David, is there's different strategies. And I'll be the first person to tell somebody, don't dive into Ethereum to USDC, right? But that's only don't dive into Ethereum to USDC if you want to witness the upside of Ethereum and kind of accumulate more Ethereum, right? Now, you could dive into Ethereum to USDC if you're expecting the market to move down and you want to use it as a dollar cost average strategy into Ethereum on the way down, or if you're looking to sell your Ethereum on the way up, because that's a feature right there. Another thing is if you're looking to just produce income with minimal market exposure, maybe you don't care about having all the upside, all the downside. You can run an Ethereum to USDC strategy where you hedge out the exposure and stuff. But yeah, I think a lot of people just they aren't aligned on their strategy versus what they actually invest into, right? They might want a specific thing or have a specific goal in mind, but then what they're investing into, little do they know, is not in line with that, basically.
Yeah, Jake, I agree with you.
Let me kind of just drill into that for a second for those listening. So basically, and correct me if I'm wrong, Jake, what you're trying to say is say somebody's strategy is to build more of an asset. They want more ETH. And so basically what you're saying is that the pools or the DeFi plays that they're doing aren't in line with that. So they're actually losing exposure to ETH, thinking that they're actually gaining ETH because, either they're not tracking it, using something like metrics or, a tracking sheet or something, and they're seeing that they are earning yield, but they aren't paying close enough attention to understand they're losing exposure to ETH. Is that kind of in a nutshell what you're saying?
They look at APR and they look at earnings, and that's about it, right? So what that means is like somebody's goal might be to accumulate more ETH, but then they run Ethereum to USDC and Ethereum might move down. So theoretically, they have a great situation where they just dollar cost averaged into Ethereum on the way down. But then what do? Like, oh no, I'm out of range, must rebalance. And then they go and they swap half of their ETH that they just bought for a high price, and they have to sell it at a low price. They buy high and then they sell low. That's essentially what they're doing.
Whenever I go out of range on the bottom end, I always just leave it because I don't want to realize that impermanent loss and make it permanent. And basically I'm just hodling. That's why I always say, make sure that believe in the assets that, in the pool that you're in, because basically now you have a hodl bag. And if like for me, USDC wrapped ETH, when I got in, like you were saying, as the price of ETH went down, I was selling USDC into more ETH. And so I have more ETH at the bottom. And when it comes back into range, I start earning again. And of course, it's going to do the reverse. It's going to start selling ETH into USDC. So you need to understand these nuances. And like Jake was saying, make sure that they align with your goals. So David, sorry, go ahead.
No, 100%. And, so here's a question for both of you guys. If your goal is to accumulate more of an asset, is it better to provide liquidity in that asset and allow the pool to buy it for you on the way down? Or is it better to hold your stables and set levels for yourself to just buy it spot on the way down?
I think people like me that aren't, as intelligent as you on charts and things like that, I think being in the pool is better, because I'm not watching charts. I don't know how to read charts. I can be in a liquidity pool. I can be earning. If it, goes down in that range, it's doing it for me. If it goes up, it's, doing the reverse. But all the while, I'm earning some yield. So I think it has a lot to do with experience, and kind of knowledge. But again, I interrupted you. Sorry, David. Go ahead.
Well, yeah. So what Jake mentioned a couple of minutes ago at the beginning of the call about his outlook for the next couple of months. I have started to accumulate ETH because I expect that once there is real regulatory clarity in the United States, that Ethereum will start to significantly outperform Bitcoin this year. That's kind of what I expect to happen. So I'm starting to
they're paying yield now on staking.
Yeah. So what I'm thinking here is, and I want to get the input from both of you guys. I'm curious what you both think about this. So it looks like at the end of the week, we're going to get some type of decision from the Supreme Court of the United States about the tariffs. And then on Polymarket, it looks like the odds of SCOTUS siding with the administration is like less than 25% right now. So I want to find out, what do you guys think will happen to markets if the Supreme Court rules that the tariffs that President Trump has instituted are actually not legal? What do you guys think will happen to markets?
Negative impact.
You think so? Yeah.
I mean, it's definitely going to be negative impact, but I kind of wonder about the additional ripple effects, just because what happens to the tariffs that have already been collected? Are those going to be given back to those countries? Do they go in some kind of escrow?
That's not how it works, though. The countries don't pay them. So tariffs are paid by U.S. importers. So are those?
That's what I mean, though. I mean, are those going to be like paid back, to the countries of origin where those businesses are at, and then they, pay it back out to the companies, or that's something I don't understand. I've never really done any research on. And that's what I'm talking about the ripple effects. Is the judgment is one thing, but the kind of the secondary and tertiary consequences of that ruling. How far is that going to ripple out?
Yeah, so that's the first thing that I'm thinking about, just in the immediate term, like this week. What would the impact be if the Supreme Court rules against the tariffs? That's number one. And with the S&P at all-time highs, it would make sense that there's a little bit of a sell-off in the S&P, which I think would drag crypto down too. Crypto tends to front-run moves like that. So with Bitcoin and ETH off, a couple of percentage points today, it kind of seems like maybe that's starting to get priced in. Maybe we see the S&P roll over a little bit. But throughout the rest of this year, it's a midterm year. And right now, the Democrat Party is leading. Like the odds on Polymarket is that the Democrats will get control of the House this year. And with all of the crypto legislation that's in the pipeline, since the Democrats don't really have a platform, it's kind of like Orange Man Bad is their platform. Yeah. If Trump is saying like, hey, we want to pass crypto legislation, and then the Democrats get control of the House, man, good luck getting anything through. So I think that would probably be bad for markets. But what do you guys think?
No, I would agree with you, David.
Yeah. So what's the saving grace here then? Is it the Fed just buying, this year it looks like they're going to buy $500 billion of bills? Is that going to provide the liquidity to get us through? If tariffs are gone and if Republicans lose control of the House, why be bullish in 26? Because midterm years tend to be bearish.
We actually have a gentleman, I could be wrong, but in our episode last night, we're streaming on Arena, and there's a gentleman in there. His name is Colin, and I believe, if I remember correctly, that he is part of the Avalanche team. And so he brings something up and says, "Good luck getting elected with an anti-crypto platform." So what is, both of your view on midterms coming up with, kind of how potentially that could play out, and how big of a factor do you think being pro or anti-crypto is going to be for those midterms? Oh, okay. Colin says former Avalanche team member, Avalanche founding team member. So he's has some credentials, but that's kind of what he brought up. A good point. David, what are you thinking as far as midterms?
Yeah. So as far as the midterms go, I watched all of the Democrats get together yesterday with fake candles and, just talk about, they didn't talk about Ashley Babbitt. Okay. So like the one person who was murdered on January 6th, they didn't talk about her. And I also look around the country at what's being uncovered in Minnesota, what's being uncovered in California, what's being uncovered in Maine, all of these massive frauds. It makes me think that, man, I don't see how they could possibly win. I don't see how they could possibly win. Here's a prediction for you guys in 2026. At least one Democrat governor gets indicted. That's a prediction for you in 2026. And also, I don't think the Democrats are going to win the House back. I think that they're going to lose in a landslide because I just don't believe that they bring anything to the table at all. They don't have a platform. There's nothing. All I hear from them is anger about Trump, but I don't hear anything about what they want to do different. I don't hear like, we don't agree with Republican policies and this is what we're going to do different. I don't hear that at all. All I hear is vitriol, and it's almost all nonsensical. So, about markets here, I think that it's going to be difficult for the S&P to roll over and crash when earnings continue to grow at, double-digit numbers. So if there's a dip out of the S&P, I think it's viable. The only thing that concerns me is if there's like some sort of real violent revolution, because I heard earlier today, Tampon Tim Waltz talking about how he's going to like issue an order to the guard there, the National Guard in Minnesota.
I saw that.
Like,
I saw that
bro,
video.
That's really, really not good. That's really not good. So like
Well,
something like
and
that would be
from a
bad.
military, I'm ex-military, retired, and honestly, it's unlawful order. But it all depends on those of you that don't know, the National Guard, they're actually the Minutemen. Their commander in chief, their direct commander in chief is the governor, but um, that doesn't mean that you have to follow the order if it's an unlawful order. And basically him ordering them to activate and potentially go against law enforcement is not a lawful order. So it depends on if the drawn a blank. Basically there's a general that's in charge of the National Guard, but it depends on if that individual listens and complies. So anyway, sorry, go ahead.
Well, yeah, so I think the big risk here from all of this social chaos is in the bond markets because all of these states, and it's not just blue states, unfortunately. I think what Elon Musk says about it being 90% Democrat and 10% Republican in terms of the fraud, I think that's true. But like the big problem is that it's not like you can just defraud a state of tens of billions or hundreds of billions of dollars and then just go, oh well, sorry. That's not how this works, because all of those municipalities and small towns and unincorporated areas, they won't be able to borrow anymore, because who in their right mind would open up, would lend to a town if they know that the last time they lent to the town, they had to default on their bonds, on their obligations, because they gave away the money in fraud. So that's a big problem. If all of a sudden all sorts of towns all over the country, infrastructure starts falling apart and they can't borrow to fix it, man, that is a big, big problem. So that's kind of what I worry about with this. I worry that the fraud that's been uncovered so far is the tip of the iceberg, and that it will have follow-on consequences for real people who pay real taxes and feel like they're just getting screwed. Because when you pay half of your income in taxes, only to see people opening fraudulent healthcare and daycare centers making millions of dollars, that doesn't exactly make you feel too good about the system that you're a part of.
Well, I actually, like a little over a year ago, me and Drew over Blockchain Basement, we did a video, and I did a bunch of research, and I'm going to ask David, you about your past job that you were sharing with me, if you don't mind sharing that. But I did a video with Drew, and we showed, all that global warming initiatives that Biden was doing. I basically went through and tracked down, where that money was going, the actual organizations, the NGOs. And those NGOs, a couple of them were actually run by ex-Weather Underground, which back in the 70s, those of you that don't know, was basically an extremist group, a domestic terror group here in the U.S. And they did a bunch of bombings, robbed a armored car, things like that. But a bunch of the founding members and old members are running NGOs now. And so they were funneling money through there. And then those organizations were giving it out to, the BLM groups and the Antifa groups and a bunch of organizations that were helping with the illegal immigration. And then that leads to what David, you were telling me, if you don't mind sharing that with how they were getting those people all of the necessary documentation so that they could vote.
Yeah. So, I used to work in healthcare and I speak Spanish. So one of the healthcare facilities that I worked at was for Spanish-speaking people in California, okay? And they were almost all illegal aliens. And so this is what my job was, okay? My job was to get them services, okay? And so most of the people at the facility were there illegally, meaning they don't pay into the system, okay? So number one, to get a bed, it's like $6,000 a month. Well, who's footing the bill for that? Because the illegal aliens that are there, they don't pay taxes. They're not footing the bill. Taxpayers are footing the bill. And that money is actually just federal Medicaid money. So in California anyway. So number one, the first thing that we would have to do is get these people a Medi-Cal ID. because once they had a Medi-Cal ID, that was a back door into getting a social security number. After they had a Medi-Cal ID, we would get them an ID, an identification card, and they would be registered to fucking vote and get a driver's license at the same time. Almost all the time. It happened at the same time.
Yeah.
So number one, they get a Medi-Cal ID. Number two, they get a social. Number three, they get an ID and a driver's license. They're registered to vote. And in California, you can't show ID when you go to vote. Make that make sense, man. So the amount of resources that someone who is here illegally would drain from the state is measured in the hundreds of thousands of dollars per individual. So, yeah, man. And that type of fraud is just endemic. Like, I can only imagine how many tens of thousands of people were doing the same job that I was doing all across the country. And in the moment when I was doing that work, I thought I was doing the right thing. Like, this compassion, you want to help people, right?
Well,
But
I mean,
looking
we
back
all
on it,
want
bro,
people
it
to
was
feel.
horrible.
I mean, we all want good things for good people, and it's not that, immigrants, illegal or otherwise, are, inherently evil or bad. I mean, they're breaking the law, coming here illegally, but at the same time, I have a neighbor. I'll give an example. She's from Thailand. It took my buddy next door, it took him, I think it was like 6 or 7 years after he married her to get her here to the States. They had been trying for about 13 years to get her son over here, going through all the legal processes, applying and paying all the fees. And, it cost $10, $20, $30,000, after it's all said and done, and a lot of years. And finally, they got him here. And, I live up by the Canadian border. I was like, dude, why didn't you just fly him to Canada, have him walk across like everybody else and, save yourself the time and money?
Well, yeah, but Mike, the thing that's so infuriating.
But I mean, come on, we need some reform.
But bro, the thing that's so infuriating is that, like, in California, Medi-Cal is really, really good insurance, man. Like, I was a case manager, and my job was to know how to navigate the bureaucracy to get people the very best services I possibly could. And I was very good at my job. And if you know how to navigate the bureaucracy and you're patient enough, you can get phenomenal healthcare, 100% paid for by the state and federal government if you're on Medi-Cal. The problem for me as a tax-paying citizen is I don't qualify for those services. And yet all of my taxes go to pay for them. Yeah. And it's like, man, what the fuck? Like, that's totally wrong. Like, the system's totally broken. And so when we bring it back to markets here for a second, and we think, okay, well, if on Polymarket, it looks like right now today, the Democrat Party is favored to win the House. Well, if they win the House, you can kiss all the crypto regulation goodbye. That would be very bad for Bitcoin and ETH, I think, and everything else. But I think it's unlikely that they win back the House, because I think that over the next couple of months, we're going to start to see a lot of people get indicted, because there's really, I hope so too, man, because there's really no way to explain
all of this
it.
is pointless. Finding all this fraud and, nobody having to, be brought to task on it it's just pointless. You have the same politicians doing the same stuff over and over again. They never get in any kind of trouble. And if they do, there's a congressional hearing, they, yell at them and shake their finger at them. And then they just give them a new job somewhere else, often making more money, having, more power. And it's just the same old thing.
It makes no sense, man. Like, this fraud is right out there in the open. It's so blatant. And yet nothing has been done about it. And this has been running for decades. It's not like this just happened last year. So hopefully there's voter ID nationwide. And hopefully there are major indictments. And, people are, if they're going to fuck around, they're going to find out. We need to see some of these Democrat politicians get Maduro'd and be perp walked, man. Like, for real. Otherwise, people are going to stop paying taxes. Like, you can't have that, because if the law is only applied to law-abiding citizens and no one else, what the fuck? The social contract breaks down,
Oh, yeah.
Yeah.
Well, we got about 15 minutes left. Let's circle back to kind of, the markets and DeFi, just to, kind of finish this out. Because I mean, I'll be honest, I could talk about what we're talking about for hours.
Me
And,
too.
maybe David, if you've got sometime, maybe me and you should get on and just, rant and rave,
How
shake
about
our
Friday?
shake,
Yeah,
shake our
let's
fist in the
do it
air.
on Friday, man.
No, we could do it on Friday. So, or we could do it tomorrow. Actually, I don't got a show on Thursdays.
We should live stream it. Yeah.
Absolutely. Jake,
Yeah.
I mean, give us like a 5 minute or so, kind of rundown on, some of your thoughts on the markets right now.
I mean, again, I think it's just like we're in that stage. Like, no one has a crystal ball at the end of the day, but I think everybody realizes that external factors affect the markets, and that's the biggest driver. We're at that uncertainty stage, just like you mentioned, David. It's a midterm year. Is that good? Is that bad? It depends on the specific outcomes. So yeah, I mean, again, it's about structuring for uncertainty. So when it comes to structuring for uncertainty, like, my personal rule of thumb is like, number one, don't invest what you're not like willing to lose, but number two, have both, have accumulation, have stability strategies. With your ranges, go broader if you're trying to accumulate, just because volatility will kick in. We've seen that over the past couple of weeks, like up, down, we want to make sure that we can factor that into our portfolio, not just instantly get kicked out of range. And don't get too greedy, but do be greedy. Like, be greedy in the sense where, like, if you're just holding, do something about it. Like, actually, like, holding's the worst thing you can do. I mean, it's better than not investing in crypto at all, but like, do something about your holdings and put them to work. But then when you start to do that, don't get insanely greedy trying to get like 100, 200% per year. Go for the stuff that's lower yield, lower risk, and it's going to give you somewhat of a certainty within your portfolio. So, yeah.
100%. Yeah. I think in the post or in the midterm year, unless earnings start to deteriorate, which it doesn't look likely that they will, then I think any dip for the indices like the S&P and the Nasdaq, or the Russell, even maybe the Russell less so, but the S&P and the Nasdaq for sure, I think any dip out of those indices is probably buyable, just because earnings continue to grow. So unless there's some type of external shock, like what we've just been talking about, and there likely will be, but even if there is, I think that dips are buyable, and that's why I've been starting to accumulate ETH, because I'm going to be buying ETH all the way down to 2,000 if it gets down there, or even lower, because I believe that Ethereum is the future of finance. I think that blockchain, specifically Ethereum, is the future of finance.
Mm-hmm.
And I want to hold as much ETH as I possibly can. So the one challenge with ETH, though, is it's so difficult to value. Like, you can't really apply, a discounted cash flow to Ethereum, because if you did that, it would tell you the price should be like $100 or something. Like, a DCF model doesn't really work. So I think it's got to be something around the number of users and the value that each user accrues to the chain. And as we get regulatory clarity, which, man, I really hope they're able to get that through Congress like sooner rather than later, I think that will be the biggest driver for Bitcoin and ETH and for crypto, is knowing what's legal. Because all of a sudden, once you know what's legal, these massive institutions that have just started to allocate to crypto, they will open the floodgates to all of these new users. And I think that's what crypto needs, is the user growth. And you got big institutions.
In tech, we call it a barrier to entry.
Yeah. So I think regulatory clarity means institutions open the floodgates to new users and number go up. But if the Democrats win the House, then we don't get regulatory clarity, I think. So thinking about that.
Yeah. No, that's a really good point, because I mean, I have an idea, and this is my closing thoughts. I have an idea of kind of why it seems like overwhelmingly that it's, and this isn't a partisan thing, because I'm biased and I'm more right leaning, but Gary Gensler, Elizabeth Warren, they were very, very left leaning. Pretty much every politician in Washington and person that was put in a position of power was pushing back and fighting crypto tooth and nail.
Mm-hmm.
And you can look for yourself. I don't take my word for it, but the donations that Elizabeth Warren got, how she became a millionaire, a lot of it because she is on the finance committee. She gets a lot of money from special interest groups and lobbyists that work for the banks. The banks did not want crypto to happen unless they were able to dictate the rules. Because with DeFi, we, the people, are able to borrow each other money and charge fees and, lower interest. Banks do not like that. They want a monopoly. And so they were pushing back. They're fighting right now. The Genius Act that was passed for stablecoins. They are fighting because they don't want stablecoins to be able to pay people yield. Again, because they lose power and money. So, you need to understand how to pay attention to politics, but kind of put your politics aside when it comes to your investing. If you're left leaning and you're in crypto, you need to understand that just because Democrats are pushing for something doesn't mean it's a good thing. And the reverse is true. Just because you're right leaning and the Republicans are pushing for something, it doesn't mean that that is, good and, awesome, either. We need to understand that ultimately those in government do what's best for them. They do what's going to keep them in power, what's going to, keep the money flowing for them and, keep their party, going. So and this isn't, I hope this doesn't sound like I'm on a soapbox, but please stop playing into the partisanship and the propaganda that is put out. Start paying attention and doing your own due diligence. Don't just take what's spoon fed to you. Yeah. I know it's difficult these days with AI and social media and, clickbait stuff, but we as citizens, it's our responsibility to be knowledgeable about these things and hold our government accountable. This fraud is just the tip of the iceberg. It goes much, much deeper. I saw it when I was in the military. I was always calling it out, just fraud, waste, and abuse. And I was often somewhat penalized for pointing it out because that's how business is done in government. It's wasteful. The Pentagon, they have failed 9 straight audits. Let that sink in. With the budget that the Pentagon gets, that the Defense Department gets, 9 straight audits they failed. We need to start paying attention before we lose our country. And it's going to get really painful if we don't come together as citizens, right and left and middle, and hold our politicians accountable. So sorry if that sounded a little soapboxy, but I cannot stress the importance of it. So, gentlemen, thank you so much. As always, David, let's talk after this. Let's schedule something for tomorrow, and we'll get up on our soapboxes again and talk a little bit of politics.
America.
All right, gentlemen. I want to thank everybody on the arena for showing. Colin, I followed you on X. If you want to follow me back, I'll shoot you a DM and we'll get something on the calendar and have you on the show. So till next time, Veteran Crypto out.
Peace.